So this is Noshee from Genie. I trade stocks and options and futures. And this presentation is about how I go about doing my things and how I communicate to the members and what the members are supposed to do, when they sign up and then when they start receiving our trade messages via email and SMS. So I explain a little bit through slides. So we receive questions, what this mean and what that means and what I'm supposed to do, etc. So this is a way to educate. We do have a 71-page guidebook, so we send out that. It's called Trading System Guidebook, and then there is another one, 21-page option trading strategy, where I wrote some strategy which I use. And as the time evolves, things change. So I use I'm not only that, but I'm doing something else also. So in this presentation, I'll explain how the trading system, um, from your point of view, works, so you can take advantage of our trading alerts. So the day for me starts for the next day. Let's say today is Wednesday. So for me, I prepare for tomorrow's market a day earlier. So when the market is about to close, so let's say that today the market is about to close, so I do my debriefing to myself. So it takes like 10 minutes. So I go over all the things which happened, the trades closed, the new trades open, and what I saw, why I made that decision, and what happened. What are the targets? What are the stops? What were the market conditions? So I debrief myself every day around 12:45. If I don't get the time at 12:45 Pacific, then I do it in the evening. So in the evening after 5, 6, when I get the time, I sit down and go over my day. And I also prepare my watch list for tomorrow. The watch list is getting ready as today for tomorrow or for Thursday. It's just that we go through the list and add some more symbols, remove some symbols, to see where they are in their overall life cycle or chart, whether they are watching for reversal or watching for move up or move down. So, for instance, GS. So I'm watching GS for puts. So I've, I kept it on my it's on my screen. Yesterday I got it. I shot it just so sometimes I short a little position just to see what's going on. So it's in front of my screen. So I shot it and I covered around 375 and it moved up. So it's still not ready yet to fall the way I want it to fall. So there is a support at 375. So I said, okay, I cover it and then I keep it on radar. So I'm keeping it on radar, the GS for puts. So if it breaks today's low tomorrow, so I will see it and get in. So that's one way of preparing my list, and then intraday prepare the list. So today's, let's say it's in Estee Lauder, it was not on the list, but it came as a mover, fast mover, and breaking the resistance with a good volume and non-stop move. So got in the Estee Lauder and some other trades. Some we closed, the open, some our positions are open. So I'm also watching Meta. It so happened that this chart, this slide talks about the Meta. So I'm watching Meta for long. Today it was moving, and so it hits 112 plus and it pulled back. So next time when it moves up, that's where I get in. So I closed Neo today. I closed PXD puts, close UPS calls. So 3, 4 trades. So so let's say right now Meta is trading at 111, but let's say it's Meta is close to 128, 129, and it's the month, it's December. So it's just for example's sake. So if I decide to buy Meta, so the way the strikes So the way the strikes are selected is also based on a lot of factors. So there is a different presentation I'll give you where we select the strike. So depending on the spread, depending on where the stock is, depending on where the support is, depending on where the target, depending on the market conditions and the volume in that option, the open interest, and what kind of activity is happening, how fast that trade will move or how slow it moves, etc. So based on all those factors, which I explain in detail, decide that okay, 130 strikes. So the first message which goes to the members is in a subject line: Meta December 130 calls buying to open at 10. So we always buy the third Friday expiry. That's one thing. So always third Friday, unless it's third Friday, unless it's specified. So December 130 calls, buying to open at 10. So the way to understand is the stock is Meta, its month is December, its strike is 130, the trade type is calls. So calls or puts. So in the trade, the calls go first. So it's like Meta equal calls, and then December 130 buying to open at 10. And then if it's puts, then Meta equal puts, and then equal December equal 130 equal buying to open at 10. So this is what it is. Suggested price is 10 and the third Friday expiry option, unless it's specified that there is another expiry. So we always buy the standard option, third Friday expiry. Once we buy that, so once the trade is stabilized, for instance, we know that okay, now it is stabilized and it's now moving in a correct direction. So it's not moving haphazardly in the other direction, or it's not doing something. So once we understand that okay, this we have gone through the targets and the stop even before sending. So I've gone through that. After 10-15 minutes, then I sent you another alert with the targets. So the targets are determined very accurately based on the support and the resistance levels and where were the turning points. The so to understand the targets, take into consideration of its um, volatility, so how much it moves, take into consideration the support and resistance levels, take into consideration where were the previous turning points. So the turning points are quite visible on an intraday level chart. So if you look at the 60-minute or I look at 65 minutes, so 65-minute chart. So if you divide, there are 390 minutes in a day. So 390 minutes, if you divide equal bars, so equal bars, so 390 divided by 65. So I get 6 bars. So instead of 60-minute bars, you get 6.5 bars. So I divide the time interval into 65 minutes. So for me, the lowest time frame would be 13 minutes, just the two for equal. So 13, then I look at the 26. So if any trade is developing, I'm looking at 13 minutes, then I'm looking at 26, then 39, then 52, then 65, and so on. So multiple of 13. And then the lowest time frame, just to see what is happening before pushing the buy button, look at the 3 or 5 minute interval. But if something is developing to the upside or downside, then I start watching it on a 13-minute, and the 13-minute bars will develop into 65-minute bar, and then it goes into the daily. So if I look at the 65-minute chart, all the turning points are there, all the tiny candles, the big candles, and all that as resistance levels. So based on that, I determine the target. I take into consideration the ATR. So what is the normal move? So sometimes the move is so big, ATR is big, like $10. So that cannot be the target. The first target, if I'm buying something at 220 and the ATR is 10, then if I say, okay, one ATR target, then it becomes like 230 is the target. So that's too far. So I take into consideration what else has happened between 220 and 230. So let's say there was a turning point at 228. So for instance, the first target I said is 228 and got in at 221.70. So it hit 228, already hit 228.29. So the green target is hit already since morning, and exactly like 228 was the target. So these targets are determined and fed into the system. So I've developed a system where I feed those targets and have a table of the target. So if you ask me 6 months from now, what were your targets for this trade? I would tell you because I have this system of documenting things. I believe in documenting and maintaining the data and then analyzing the data. So there's a lot of work goes on in documenting and uh, accessing the data from other third-party platforms and then programming it and then storing it and then analyzing it, knowing what's happened before, what were the targets before. So all that goes on, and then so it's a science and it's an art. So the target must be determined like a precision guided missile. The stock goes and hit, uh, boom. So the 228 actual target was 228.10, so I just rounded to 228 for the green target. So I'll explain what is the green and yellow and red target. So when I started this 10 years ago, so I was saying, okay, first target, second and third. So I came up with the name green, yellow, and red just to explain to you, the concept of the target. It's like traffic light. So the first target, I call it a green target, and the second target I call yellow, and the third target is red target. And then there is a beyond red target. So I explain to you what happens in the market in terms of the targets. So just imagine the green target. So green target is for Estee Lauder is 228. So the green, what are the characteristics of the green target, which is the first target? So green target is the immediate target. So if the first target should be large enough that it gives you the profit, a decent profit, and there should be a high probability of the stock hitting that target. If the ATR is, let's say if an ATR of a stock is 10, and it started running at 220 and I got at 222. So 210 is my, let's say, estimated target, 220, 230. So from 220, $10 to 230. So I reduced it to 228. And the reason for reducing it is also you cannot catch, even the top traders, they don't catch all the moves. They just catch the 60, 70% in between for that day's move. So for that day's move is, let's say, $10, so it's already happened. So out of 10, I'm trying to catch 8. So when I'm reducing it, the probability is very high. So if the target from current price, the target is estimated correctly for that day, then it has a very high probability of hitting the target. So the green target is such that there's a high probability of hitting the target. I have not sold it, I just holding it. So I don't know what option, maybe option is up to $300 per contract. So the if you so now it depends on you how many contracts you have based on your portfolio. So if you have let's say 8 contracts, you may sell 2 contracts at the green target. So 2 contracts at the green target. If you only have one, then you hold. Don't sell at the green target because the green target was just the immediate target and it has a very high chance of hitting it, and the stock is expected to continue to move up. So if you have one contract, then don't sell it. So because the stock is expected to continue its journey towards the next target, which is based on some resistance. So the first target is just based on some ATR, and I make sure that there is no resistance in between. So from A, if the stock is going from A to, let's say, A to D, then there is no resistance at B and point C. So if there is a resistance between A and D, distance from point A to D, then if there is a resistance at B and C, then what kind of resistance it has? Is it a very strong resistance or it's just a weak resistance? If it's a weak resistance, then the green target is valid. So if, for example, if 220 is where it started and 222 is the entry price, 210 is where some resistance is minor, then based on the ATR and the resistance, my target become 228. Now in between, there is no resistance and it has a free flow move. And the way the stock is moving with momentum and the volume and the buying, so all that is helping the stock to go and hit that target. So the buying pressure is helping to for that stock to hit that green target. So when the target is hit, then we may send you some alert. So the matrix is there. So we have developed a matrix where, based on certain conditions, the sell target is generated. So first I see it, and then I evaluate, and then I send it to the members to sell some or sell one third or one fourth. It depends on the position and how much I expect further for the stock to move. So some kind of sell alert is sent when the green target is hit, and we have a decent profit. If sometimes the green target is not hit, or even if it hits, but it took time. So it's not like every position goes and hit the green target right away. So if the green target doesn't hit, or it hits and there was not a decent profit, then the green target gets revised. So the yellow target, which is the higher target, which I will explain, um, the yellow target goes into the green target. Then I come up with the replacement. So replacement, the third target, which is a red target is inserted into the place of the yellow target. Then I come up with another red target. So, so in other words, if there is not a profit at the when the target is hitting, then we revise the target. So after the green target, which is the first target, the second target is the yellow target. So yellow target is the target where some kind of a resistance is there, some turning point previously. So, and it's further away. So if the green target for Estee Lauder is 228, maybe the yellow target is 231. So some fraction of ATR, so some multiple of ATR. So if let's say if ATR is 10, then maybe 1.3 of ATR is the yellow target. So if it's 1.3 of ATR based on 10-day average is the target, then it comes, let's say, 231. So if 231, the answer comes at 231, then I say, okay, it's 231. Uh, is there a resistance? And I say, oh, there is a resistance at 231.50. So I cannot place my trade target at 231 because the resistance is at 231.50. So I am not in the business of squeezing the last penny. That's where traders lose when they try to squeeze the last penny. If you can capture 60-70%, you are in the top. Uh, the top traders, they squeeze only 60, they capture only 60-70% of the move. So don't try to squeeze all the pennies. So jump the ship before you can master your exit if you can, based on the chart and knowing that the target is 231.50 resistance. And if you have a solid discipline of you know finding the exit on a 3-minute chart, and you already know, okay, 231.50 is the resistance, and I'm not setting these seller in advance, and I know I'm expert, and I go and watch in a 3-minute, and boom, when 231.50 hit, and I see it's not crossing and it's moving down, I sell. But most of the time, before you push the mouse to sell, the it's already trading at 229. So better to set the target alert sell order at 231 or 230.50, something like that. So the third target, second target is the yellow target, is based on some resistance minus something. So based on some resistance minus some offset, something which tells you that I need to put some leeway, some cushion. So, so since the yellow target is the second target and it's further down, so the probability is less because the stock doesn't go straight and hit all the targets unless there is a lot of momentum building up and it just keeps going, going, going and hit all the targets yours. So it's like you're going from San Diego to Seattle, the GPS tells you um, driving time, let's say 24/7, 27 hours, but um, you cannot go unless you keep driving straight and there are two, three drivers and you're sleeping in the car and not taking any stop. You can go from San Diego to Seattle maybe in 27 hours, but that's not possible. So you will arrive in 3, 4 days. So that's what happened to the stock. The target is there, but the stock pulls back, goes here, do its thing. Sometimes it comes back to your entry price, and sometimes it goes below the entry price. Then it bounce back up, go to green target, and then it goes and hit the yellow target. So there is a probability it doesn't go and hit the yellow target. It just is linger in between green and yellow. So when that happen, when it's lingering between green and yellow, so I watch how many days it has taken that the green target has been hit, yellow target is not hit, or even the yellow target is hit, the profit is the same as it was in the green when the green target hit. Why? Because there was a time decay. So when there was a time decay, although the target is yellow, but the profit is the same. So that's not good. So so just watch in between what is happening between green and yellow. So there is a 85% probability of a stock hitting this target. And because it's based off resistance, so the yellow target is based off some resistance below the resistance for the calls for the long position. And for the short is based and puts is based off some support and above. So if the support is at 30, the target would be 30, 60 or something like that. So because there is a resistance, so resistance mean the meaning of resistance is there is a seller there. So that's what it means. There are sellers. That's what resistance. So if there are sellers, the stock will pull back. And maybe there are more buyers than sellers. So if there are more buyers than sellers, then the stock will just keep going up even after you sell everything. But trading is a game, and you need to trade based on the rules. And if you follow your rules over the long run, you are expected to win, even though in the short run, you are expected to lose from time to time. So if you lose short term, but over the long run, you are expected to come out ahead. So we send you the alert. So we have a matrix, a system which triggers and tells us that what how much needs to be sold. So sell 3/4. So majority of the time we send you the alert to sell majority. Majority means 3/4. Meaning is that we expect the trade to just linger there, and it may move, it may not. So you have enough profit in your trade that you don't regret if you have one or two contracts left, that even if it come back to your entry price, it does you don't mind. So keep that in mind. So sell majority. So our alert triggers sell majority or sell 3/4. That's what the sell alert is triggered. So if you have 8 contracts, you sell 6. So sell majority alert is sent. Uh, if after the yellow target is hit, and I expect that the stock is now expected to move towards the red target. So let's say the red target for Estee Lauder is 237. The green was 228 and the yellow is 231. So now the 231 and 238. So evaluating the move between 231 and 238, that's the red target. If the stock doesn't move in next 2, 3 days, then we send you the alert to sell the rest. So just sell the rest and close your position. Sometimes when the yellow target is hit, we just say sell all and get out. Like yesterday, regretted, so send the alert to sell Baidu, and today I moved another 9, 10 points. So I'm just regretting. So, there is a regret always that missed a big profit, sold early, one day early, just one day early, because it was hitting the resistance and it just sold all and didn't keep some. So Baidu is gone. But on the other hand, so think about it over the long run, if you follow the rules. So on the other hand, the Tesla. So Tesla target was 187, between 187 and 188. So sold all. Tesla calls 2 3 days back. Then it pulled back to 179. So if I had not sold all Tesla, then I would have been regretting that it came back to my entry point. So there is balance. So rules. So follow the rules and it's okay. So if stock hesitates to move up, sell rest. So that's the yellow target. Now the red target is the third target. So this is the ultimate target. This is where if it hits, you make a lot of money. So if you enter at 222 in Estee Lauder and the red target is 237, it can go to 250 also. So and if you're holding it, you may end up making a lot of money if it so happen. So the third target after the yellow target. So it's red target. So I call it red, and the red is like this. And the reason I call red is just like traffic light. So even the kids know, the adults don't know, but the kids know that the red means you need to stop at the traffic light. So the little kids know. So that's the meaning. The red is the ultimate target, which is based off many factors. So resistance, major turning points, overbought, oversold levels. There's something happened before, major turning and etc. So major turning point, major resistance where it took, it banged its head multiple time and was unable to cross, or it hit and then it reversed. So something was there. It will reach overbought level for calls. So their stock get overbought, and then when they get overbought, they just stay there or profit taking takes place. So the red target is based off that concept. So the third target, which is after yellow. So since the red target is far from the entry point, so it has a lower probability. So it's like if you are traveling from San Diego to Seattle and Seattle is yellow target, then you go like 500 miles up north into Canada, and that is your red target. So there is a border in between, and then there are mountains and jungles, and then finally you arrive somewhere in Canada. So it's hard. You just can't go straight to Canada from San Diego. So there's a 70% probability of a stock hitting this target. So you may end up at the border and then you just come back, you forgot your passport. So 70% of probability of a stock hitting this target. So knowing that, there is a high probability. Sometimes the calculate is just let's say I did the calculation based off something, and my calculation was by few cents, 40 cents, 50 cents, it depends on the stock, or 5 cents. It just uh, we missed that target. So, and the stock starts to reverse. It didn't reach, let's say the target was 237 for Estee Lauder, and it went to 236.50, and then it just start to retrace and come back down to 231. So missed by few cents. So be careful when you're setting your sell order. Whatever is the red target, you make some leeway, and because it's based off some major resistance, some major turning point and overbought levels for calls and oversold levels for puts, there is a high probability of that stock to hit the target and then significant pullback occurs. And the significant pullback could be that the move is over. So it's like, okay, now the move is over, you're back to square one. You may end up at the entry point. So when the red target is hitting, so we know what kind of alert we have sent before, whether we send the sell majority or sell half or etc. So we track what kind of trade alerts we have sent to close. So if we send sell majority, then we will send you the alert to sell rest. So because we know you have little left, or sell all. So sell all, sell rest. Sometimes we do send the alert to sell half if the red target is hitting fast, and then we know there is a further chances of the stock going above. So there are some ways to figuring it out that the red target has been conquered. So it's like some major resistance has been conquered, and now the stock will move further. So it's like a river. You're on one side of the river, and you jump on the other side. So now you know the major river is crossed, and now you're on the other side. So that is gap up. So when the resistance is conquered with the gap or with the bang, like a cannonball, the volume and everything, so then you know the resistance has been conquered and the stock has further chance of moving up. So how that resistance is conquered, you have to understand that. So when I look at it and I say, okay, yeah, this resistance is conquered, the red target is achieved, and the stock has a further move up, then I send further alert to hold. So there is a hold alert to please keep holding. I immediately send the emergency email to keep holding. There is a further move up. So if you still have it, you are holding it. So now after I send the hold alert, so the first thing is that if the stock is moving quickly, then all I need to send you is to hold. Then when you receive the hold alert, which comes in a few seconds, and then I go and revise the red target. So the red target is revised. If it's call, it's revised upward. If it's put, it's revised to the downside. So the red target change, revised red target, and red target is revised to capture more gains. So that's the purpose. So if the stock has gapped up, I expect the stock is continue to move up. So sometimes the gap, there's a false gap. So if the gap is a fake gap, so if the gap is, there are not many buyers there, there's just a market maker who just gapped it up. He saw some demand and he just opened the market, he gapped it up, and then there's no more demand. So his stock, let's say tomorrow, Estee Lauder right now is 226.65, and it gaps up above 231. And if that was a red target, then it needs to hold that 231 and they keep going. If it reverses and it start to crash, then that was not a right gap, so we need to sell. So when I see that this red target is achieved and is it will hold, so I send you the revised target. So that's one way of sending you, one reason for sending you the revised red target. So now if you see the stock is hitting the red target, then you as a trader need to understand what you can do. So if you have been trading on your own and trade alerts are your ways of looking at the trade ideas, and then taking the trade or not taking the trade is skipping. So there are members who are expert, they skip the trade, they take the trade, they hold more for longer duration, they add more to the position, the scale in and scale out, they do all that. So so if the red target is hitting, the stock gaps above red target. So if it's a call position, if it's a long position, and it should stay above red and it's safe to hold. If it breaks below the red, then you need to sell immediately. So the red target is like a line on a river. So it went on the other side of the river, and then when it comes back on the other side, then you need to sell, because uh, the stock tried to break the resistance, but then there were enough sellers that they drove the market back down. So it's not good to hold. So that's, but if it's holding, then you can maximize your gain and keep holding it. So revision of targets, how the targets are revised. So targets are adjusted upward for calls and targets are adjusted downward for puts. So what I do is I move the red target to the yellow target to the green target, and then I put a new red target. So most of the time I'm doing that, or simply revise the red target. So the first target price is replaced by the second target price, so higher for calls. Second target price is replaced by third target price, and a new target is given. So immediately I send you another target. Say, okay, the target is 249. And there is a possibility of, so the targets are not always revised to the upside. There is a possibility the target can be adjusted to the downside. So if the stock is hitting, so this is where the flexibility comes. If the stock is hitting um, or not hitting the target and is lingering and not taking, it's not going quickly towards the target and it's taking time, then the target should be revised to the downside. So targets are adjusted to the downside or fine-tuned based on what it's doing during the trading hours. So if it's doing something, it's creating its resistance. If the target is 231, but then it went to 230, and then it started to linger, it's 230.20, 230.30, 229.99, something like that, then uh, 231 is no longer valid. Revise it to 230. So I revise it at that current price, whatever it is at that moment, and I say, okay, this is the revised target, and sell. So I do give some cushion. So 230 is there, and let's say the option is trading at 10. So I may say, okay, sell at 980, 990, or 10, some window. So you get filled in that window. So target may get adjusted to downside also because the stock is not moving, it's not doing its thing further. So these are the exits, sell alerts. So sell 1/3. Sometimes we send you sell 1/3 because the green target is hitting, selling half because um, green target is hitting, or the yellow. Most of the time, we're sending you the alert to sell majority and then sell rest. So this is the combination, sell majority and sell rest. Or sometimes we send you the alert to sell all. Let's say the stock was not doing anything. It's a green, yellow, and red has not been hit. It came very close to green target and it just pulled back. And now, 3, 4 days gone by, it's dead, and suddenly it wakes up. And it wakes up and boom, boom, it just starts moving up and it is going towards the overbought level. So today, like Neo. So when we bought Tesla, we bought Neo calls also. At that time, LI was also moving, RIVN was also moving. So all these four stocks were moving together. When the group of the stocks are moving together, then you have to decide which one you want. So Tesla was moving and the Neo so got in, but Tesla hit the target first and the Neo did not. But today it woke up and I sold the Neo today. And it went up a little further, but I sold 40, 50 cents early. So when that happened, suddenly it wakes up and start to move and reaching the overbought level. And we have been holding for a while. We send the alert to sell all. So there's no selling rest, there's no selling majority because we just want to sell all. We sold all. Sometimes we send you the sell price range for the option. So if the option is wild, trading at 10 and then 1020, then 1040, there is a wide spread. Sometimes the wide spread is created because there's so much demand in that stock. So the market maker creates the spread, lowers the bid or increases the ask, so there's a spread. So now I can tell where, if I tell you the exact price, you may not get hit. So I give you the price range, or the stock is moving so much that I estimate the upper range and the lower range based on the targets. So I give you the sell range for the option or sell range for the stop. So, or tell you to sell by the close. So it's something is moving quick, 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 quick. So I expect the stock, and let's say 1 hour left. So better to send you the alert to sell by market close. So by market close, you're expected to close that trade. So these are different kinds of sell alert, sell 1/3, sell half, sell majority, and there is the reason behind it. So next time I'll prepare another matrix and we'll create and show you what triggers this sell alert. So not only it's not so the traders, those who are successful, they have multiple exits and they have complicated exits. The entry is easy. You can buy anything you want. You just see it moving and you buy it. But when then there comes the exit, so exit is complicated. So, so exit is complicated and it should be, and there should be multiple exits because there are so many reasons for exit. There's only one reason you're buying it. You may buy it again more, scale in because you are right and you initiated a position and say, okay, I just want to buy, let's say 100 shares, and I'll add more to it when it moves up. So let's say buy Meta 100 shares. Yeah, so let's say buy at 111 Meta 100 shares. Tomorrow, if it takes out the high and moving up, then I add another 100. So that's scaling in. But there's a multiple reason for exits. So you need to have a matrix or all your exits, and what conditions trigger will trigger that exit. So the exit is like even exit protocol is triggered. So there is an exit protocol which triggered, but now you're watching your chart, a lower level chart, and trying to understand when you will be exiting and how much, and what is telling you how much. Maybe you have enough contract, you have enough shares, or maybe you have enough position. Maybe the market is not good. Maybe you have another position to enter. You want to free up your buying power. Maybe it's Friday, maybe long weekend coming. Maybe you're going on vacation. Maybe somebody is going to speak at 11 o'clock Pacific time. It's Wednesday. So many events occurring for you to decide how much you need to sell. So you can create a complicated um, exits. How many days you have been in trading? Is there an earning coming up? How many days left to the earning? Is it tonight? Is it tomorrow morning? What is the expiry? How many days left to expiry? What else is going on? So based on all that, the exit protocol is triggered, and then you take action. So pre-market or after-market price action. This is another thing you need to watch if you're in a trade and something is moving in a pre-market or after-market, then you need to watch the highs and the lows depending on what kind of a position you have and what you are monitoring, because maybe the game is up during pre-market hours or after-market hours. So and then when the regular session open, you don't realize that the game is up during the pre-market hours or the aftermarket. Everything is done, the target has been hit. Now you're just being fooled. So if the red target hit in a non-regular session like pre-market after hours, something happened, the stock gapped up and it hit certain target, that was a major target, so it's done. No more, it won't move after when the market opens. An event occurred and the stock moved, chances are stock will pull back during regular session. So knowing especially these round numbers like 100, 200, 300, 400. So always watch these round numbers. If the stock gaps up, like the other day, Disney. So we had a Disney position, and the Disney was moving heavily during pre-market, and then it gapped up. It gapped up to like $100.50 or something, and then so I laser focus on my phone. Right there, because I had to laser focus, I was just looking at not the chart, just the price. So looking at those Disney moving $100, 50 cent, 140 cent, 120, then 110, so and then 199.9. Okay, sell, because all the move, the thing which Disney has done in the pre-market hour. So there's nothing left. If it goes up, it's okay, but it can come down to 93, 94. So sell Disney. So same way, sell Tesla when it hit 187. So pre-market and after-market hours must be watched, and especially if the red target is hitting. So if the red target is hitting, then you know you have to some job to do when the market opens. Um, if the market is volatile during pre-market and there's a lot of news, the market maker will not open the option for you till he fix his books. So it may be 15 minutes. And if you're holding option and the stock is moved up to your target, but when you try to sell your option, it's not you're not able to sell. There's nothing there. He takes 15 minutes to fix his books, and then he opens the option. So the option guy, so because he has to make sure that his books is right. So by then, the stock has been pulling back. So for you, it's better to sell whenever you can because the target has been hit and now the stock is pulling back. So pre-market alert, when we see something like that, I send the alert during pre-market. So between 6 and 6:30, I send you the targets. Even though I have sent you the target before, like when I send you the alert, but uh, in order to make you aware that this thing is moving in the pre-market and this is the target, just in case you don't have the targets ready for you and you have not set your sell order. So there's something called conditional order, which I will teach you later. Is available on your brokerage platform. It's called activation rule or conditional order you can set. So if you set that, then it's easy to sell your option trade based on the target hitting. So also, we send you the alert to buy more when we see there is a position to buy more. When there is when you should be buying more to add to the position, even at the higher price. So if you bought at 3 and it's trading at 350 and is um, so when you add to the position, so I receive email, people say, okay, I'm down 50% on this position. Is it the right time to average down? Should I average down? I'm down 50% in this. So no, don't average down just because you feel like averaging it down, just because the option is trading 50%, so you want to cut, or just sometimes even when the down little bit, want to average down. So let's say bought it at 5, is trading at 450. I want to average down. So what you will gain by averaging it down, you bought at 5, trading at 450. If you bought one contract, now you add one more, your average will go to 475, and then your average goes to 475, 25 cents less, but then you increase your exposure double. You have increased your risk double. So that is not the right strategy. If it's trading at $2 and it's hitting some support and it's a brand new, looks like it's a brand new trade, you would have entered in this trade if you did not have the position. Then you say, yes, I will open. So anytime you are scaling in, either at the lower price or the higher price, you are scaling in because you know uh, you will do it as if you didn't have a position. You are initiating. So we do send out the alert to add more to the position, even at the higher price. So we say you may want to enter, add more to your position, either at the lower price or the higher price. So if it's a lower price, then you're averaging down, and if it's a high price, you're averaging up. So sometimes you make a lot of money by averaging up because the stock is going up and you're adding more to it. So that's a good strategy. So I do that. Rolling up, buying new strikes same month. So there's this is a complete topic of rolling up, buying new strike same month, buying new strike next month, and creating vertical spread. So this is a separate topic, when you should be buying a new strike within the same month, when you should be buying new strike and next month, when you should be creating vertical spread, etc., to maximize gains. Traders, when the traders sell their position and also sell the puts, collect the premium. If it gets put to them, it's okay, they like it. So all that kind of things traders do to extract the profit out of the trade. So it's not just buying and selling and some hot tip, just give me some hot tip and that's it. So trading is not a hot tip. So messages, we do send out messages, update any news, anything, or um, hold the webinar like I'm doing right now. I will hold another webinar after 2-3 days. I'll show you some charts. So I continuously provide you some education on a various topic. I'm preparing more content. This webinar will be uploaded in YouTube channel, The Real Trade Genie. There are other um, um, presentation there. You can subscribe and listen to it, and I'll post other stuff over there. So we send you the trade, any news coming up, any technical analysis, any volume update. So volume is also the key. So there's a certain way of watching volume. So I've set up the system to watch the volume. I get the alert on the volume, and then I send you the alert to take the profit. So, that we will take the profit near in maybe next 30 minutes or 1 hour, etc. So we do send you this update. We also send you update on, like I said, buy more of the same. So if we bought the meta calls at 10, now it's trading at 6. So, and we see the entry in Meta, then we will tell you if you can buy more at 6. Or if you don't have, let's say you did not have before, then you can add more to the position at or initiate a new position at 6. So we do that. You can set the conditional order for your sell order or your buy order, conditional order, which I will explain. There's a presentation on our YouTube channel, so you can go to the Real Trade Genie and look at, listen over there about the conditional order. I will teach you this maybe 1 or 2 months down the road, but you can listen on YouTube. So that's it for today. And thank you for coming. If you have any questions, send email to support@tradegenie.com. All right. So thank you.